Welcome, Rohan. Retired into the stock market session 11 plus 1, May 25th, 2025. How are you?
Good, Eric. How are you?
Wonderful, thank you. Welcome back. We're going to discuss the put hedge today, the put hedge, and also you want to talk about your spreads, how they work, some questions about that. Do you want to talk about your positions first, get that knocked out, get that out of the way, your spreads, and how that works? You did some
Sure.
spreads on Robinhood.
Yep.
By the way, did you ask Schwab what the problem was and tell him to turn on your level 2, level 3?
No, actually, I did not. I haven't got it. I was able to do spreads, so I just continued doing it on Robinhood.
You gotta be a boss and tell him, listen, I'm the boss. You do what I say. Open up my level 2, level 3. And
Yeah.
then if they don't do it,
Hoping to
then
get.
talk to a supervisor.
Yeah. Oh, yeah. It's just during the at least the work days. It's sometimes it's super difficult uh, to follow through. But yeah, we'll have to plan.
Are you the kind
And
of person
talk
that
to them.
puts? Are you the kind of person that puts stuff off to later?
Uh, I do sometimes. Yeah.
You never get married that way. You're married, aren't you?
Yep. Yep.
I also want to talk about affirmations today, and if we have time, we'll do that at the end of this session.
Okay.
Affirmations are important. You know what affirmations? You get the concept.
No, I think once you talk about it, I'll probably understand more. Yeah.
Okay, so to your spreads, a spread basically is an option play. It's a chance to get the right amount of leverage to your advantage, and you're doing it around closer to the strike price. Okay, what novices do in trading is they'll buy a call option on whatever on Apple or Amazon, and they'll buy it way out, for $1 or $2. Meaning that if stock is 200, they'll buy like a call option like 250 for $1, whatever the dollar is, or $2. And those kind of options expire worthless most of the time because they're buying way too high out of the money. Sometimes they'll buy let's say they buy $1 option or $2 option, and then Apple will move or Amazon will move upwards. Then option will become $3, $4, so they can double their money, for example, and that's the exciting part. Okay, but that's how the public novices do call options. We're going to do a spread where we buy a call and we sell the higher call above it.
Right.
Similar to when you have a cover call, you have the shares, which has value. You write the call from the shares. You basically are giving away some of your upside, not all, but some. And doing that for a predetermined premium, let's say monthly or weekly, but let's just say monthly. For our foundational trades are monthly. So we have the pounds here at 120. We have the shares, or Tesla at 350. We can sell the pounds here would be, let's say, 130 call or 135 call for $8. We get $800 a month income, and that's our business. And for Tesla, it's more like 20 points. Let's say it's 350. We can sell the 370 for 20 points, which is $2,000 a month, and that's our business. So with the call option, we're gonna, let's say, buy the well, I like to go in the money a little bit. Okay,
Mhm.
so for pounds here, I like to go 110 to 120. Okay, or 115 to 125. Okay, like at the money, in the money. And then for Tesla, I would do 330, 350, or 320, 340. 20-point spread for Tesla, 10-point spread for pounds here. So when you buy the, let's say, let's just do a pound here. Can you give me a quote on pounds here? Can you pull it up?
I think it's 123 right now, 123.31.
123.31. And by the way, look behind me. What do you see? This is
Is that
Palantir. You see, this is close 74. Palantir
right?
went to 74 maybe a month and a half ago.
Yep, in April. Yeah,
So this is to remind you that a good stock will go up a lot over time, and you can make a lot of money on it just on the share growth. Which is this one closed at 74, and now what's Palantir? 50 points higher.
right.
This was like a month and a half ago. It wasn't even that long ago.
Yep,
So when you're writing cover calls, consider that there's going to be an upside movement because what? Because we have great stocks, we vet our stocks, we have great selections, we're choosing stocks that are outperforming the market with all our
right.
12 criteria. You know, volume, dividends, stock split, share growth, return on the cover call, and PE. And these things are beneficial green flags and make the stock better. And we're going to have a lot of great share growth in some of these great stocks, Palantir, Tesla, IONQ. Oh, Hood, you see Hood go up?
Yeah, yep,
See Hood's creeping up?
yeah.
So
So
you should
all my
have profits in Hood, yes?
no, so yeah, I had profit in Hood, but all my stocks of Palantir and Hood, they got assigned uh last week on Friday because they went way above my covered calls and all.
Which means you made the maximum. You made share growth plus premium, yes?
That's right. Yes.
You should be happy. But you have
Yep.
to now you have to get back in, right?
Yes. Now I have to get back in with the
Ideally at a
Hood and
dip, but if it doesn't dip, just get back in.
right, right. So yeah, I'm just waiting for the right chance. I'll have to wait for the right chance to get back in.
Patience,
Yep.
patience. We were down like 800 points last week, one day.
Right.
But then it looks like we're going up. I mean, if I look at the S&P 500, SPY overnight, it's 570. It's down 10 cents. So we're probably gonna go up this week. My guess. And then if Powell cuts rates, we're gonna go up more.
Right.
Um, and we're looking at spreads. So I pull a pound here, and let's go in the money. So let's go at 1 month. Okay, so let's go. It's the 25th. Let's just go 25th of next month. Um, June 20, June 27th. Is that fair?
Yep.
So the stock is 123. So we can buy the one. I think I'm gonna give it a little bit of upside. Buy the 115 to 125. Buy the 115. So plus 115 for this is June calls. I have here 1380 by 1405. Can we say 14 limit? 14 limit. Go to June, go to the 115 strike
Right.
for June 27th,
Yeah.
which is 33 days. You can also do the June 20th, same difference, but I'm just going a little bit more. And then sell the 125, and that's giving me 815 by 850. Can we just say 830 limit? Sell 125, 830 limits. So we got 14. We spend 14. We get 830 back.
Right.
What's the total cost of it?
So that will be 14 minus 20.
570.
Yep.
$570. There's a couple ways to look at this. Okay, first way is similar to the having the shares and selling the cover call. You own the 115 call, and you sell the 125, which is about the bringing back money. In this case, a lot of money, $800, $830. You can do the return based on that, or you can just say, well, we're gonna buy and sell, and if you put them together, it's gonna cost 570. And I'm looking at the return to get the full spread. How many points is the spread if you buy a 15 and sell a 125?
Those 10-point spread, right?
10 points. So what happens is at the expiration, as long as Palantir is above 125, 125 is a penny,
Right.
you're going to get 10 points out of the spread, which is $1,000 back. And
Right.
guess what? It only costs $570. That's the major, huge advantage. So technically, we have $430 hidden in here in what? Time decay. Write down time decay. All we're doing is waiting for the option to expire. We buy an option slightly in the money, wait for it to expire, and we plan on getting the full 10 points. And the stock just needs to maintain or go a little higher. 570 investment, 1,000 cash out, and let's do the return on that. So we're going to do 4.3 divided by 5.7.
Yeah.
75% return. 4.3 divided by 5.7 equals 75.43% or 44% return. How would you like to have a 75% return in 1 month?
Excellent. That's great.
You could even go, if you're a little bit more secure, more safe, let's go into a little more. I'll tell you, it's still a great play. Okay. If you have $1 million and Mr. Morgan's over your shoulder and you don't want to make a mistake, you go a little bit more safe. Not so rambunctious, okay? Buy 100, okay? Call right now. 100. And sell a 115 because that's going to be 8 points in the money, correct? On the 115. And I have here, I'm going to send you a picture of this one. This is probably a great one. I have here 24.84 to buy the 100, June 27th. Right. 14.68 to sell the 115. The total cost 11.68 plus 100 for 24.84. See my pencil? A high quality pencil. It's an Asia blue.
Okay.
Minus 115.
So for 100, it's 26.80, right?
Yes. And the 115 is showing me 14.68. And the total is going to get me cost of 11.68. Yes. If you put it here on Schwab, on Thinkorswim, it shows me exactly what it is. Just click one, plus one, and click sell the other one.
Okay.
So 11.68 out of a 15-point spread, I get 432 profit potential. And let's do the math on that. It's a 15-point spread, okay? 432 divided by 11.68, which is the cost. 36.9% return. 36.9% return. How'd you like to make a 37% return in 1 month? All you have to do is Palantir just has to stay above 115.
Right.
Doesn't even have to go, it can go down or sideways or up, and you can still have maximum profit. What you're doing is just waiting for the options to expire, which is relying on time decay, similar to having the shares and doing the cover call. The difference is the exposure is different. Right there, exposure. Whereas you're doing a spread higher at the money, you're getting 75% return. But to get the full spread, the stock has to be 125 or higher. To be a little bit safer, because Mr. Morgan's over your shoulder looking, go down to 100, 115 to a 15-point spread, and now we're still getting 36%. Pretty safe. Is it safer? Getting 432 at a 15-point spread only costs you 11.68 because you're selling one, you're buying one, selling the other one, reducing your costs. Okay, relying on time decay. 36% return, 37% return, and you have a buffer down to Palantir 115. If it's 115 or higher, Matt, you get 15 points out, maximum return. Follow me?
Yep.
$432, 36% return. This is two examples of spreads. Okay, one is more safe, one's more rambunctious. One you could do maybe in front of your wife, take her shopping with 75% return. The other one you do in Mr. Morgan's office, more safe. You're doing $1 million. You don't want to lose money. More in the money. On this one, you can wait till the expiration because ideally you want to get the maximum benefit.
Right.
You can just what will happen at the expiration is pound shares 125. Okay,
Mm-hmm.
on the first one, the your account will exercise a 115 call
100.
and sell a 125 call and give you $1,000 credit.
Right.
Or on the deeper one, it'll execute a 100 call, sell a 115 call, give you $1,500 credit. And your cost again was $570 for the lower one and $1168 for the higher one. I'm sorry, I switched those. $1168 for the 15-point spread, $570 for the 10-point spread. And again, you're getting money back. And when you have own a call and you sell the higher call, again, it's protection. So it gives you protection when the stock moves. It
Right.
protects your downside. So it's 100% better. There's like three reasons why doing a spread is 100% better than just buying a call. One is it protects you on the downside when you go down. So it protects your drawdown. Write it down. Protect drawdown. Two, you can rely just on time decay to get the full money. You don't really have to, stock doesn't have to go up like crazy like you do when people buy a call option. So
Right.
rely on time decay. And then three, I'll just say this, so there's different reasons, but if you go in the money, you don't have see you're getting money back. You're getting money back. Money back. So you buy a call for 100 or 115 and you sell a higher call, you're getting money back. Technically you can't lose the whole position. Okay. If I had to invest 1168 into a call, $1,100 on Palantir without doing a spread. Watch this. This is a lot different. I would have to buy the 1100. I have to buy the 119 call for
Right.
Palantir, the 119. So the difference if I buy the call is that the upside is unlimited. I can make a lot of money in the upside. I can double my money, you know. But if Palantir closes at 118 at expiration and I have the 119 call, 100% loss. $1,100 is 100% gone.
Right.
Whereas here I have money back. Write it down. Money back at 115. Sorry, 115 on the 10-point spread, and 100 on the 15-point spread. Money back. So if Palantir was to close at 118, I would only lose. Let me see. We're doing 125. I'd lose $700 out of my spread, but really, it would be I'd own the 115 and it would be the 118. So I would have $300 out of that first spread, and we spent $570, so we'd only lose $270. We still have money back. And on the 15-point spread, if Palantir is 118, I'd have $1,800 back, and I have the full amount returned. Not $800, but I would have the 15 points back because we sold the 115. So at 115 it caps.
Right.
So the only thing we give up is the upside. It's a lot of upside when we do a spread or when we're at a cover call. We buy a call, sell a higher call. This is the idea of a spread, which is basically capping our upside. We're giving away that lofty movement if it shoots up to what? To get a predetermined great return, whether it's 25%, 36%, or 75%. And ideally with a high chance of success. Write it down. High chance of success. Because, like, at least for the 100, 115, penalty will probably be above 115 by next month. Don't you agree?
Yes, yes, most likely. Yeah.
And let's say, at least 7 times out of 10, because our goal is 7 wins, 3 losses. If we can keep that ratio, we're doing pretty damn good. Getting either 75% or 37% return on a month. I don't want you to do more than 20% of your account to spreads.
Right.
You know how I say like you do like 50% cover call, 30% dividends. If you do more than 20% to spreads, it's kind of still like it's still like gambling in call options. It's just still risky because Palantir took a big hit to 100, it'll knock out both your spreads.
That's right.
But
Yeah.
if you have the shares, well, you lost 20 points. You lost 20%. You can still
Right.
survive. But on this call option, you still get wiped out. It's not as bad as if you have one call option, but it's still risky to do it. So don't do more than 20% of your account.
Right. Right.
Questions?
So
You
it's
get
always
it?
better
Is that
to
too
do
much?
in the so it's always better to do in the money, right?
Always better, but you're investing more money with less return,
That's
but
the
what
turn.
higher chance of success? Yes.
Right.
Now, if you have your intuition, Palantir is moving. Look, IONQ's moving. I sent a little message in the group chat.
Mm-hmm.
IONQ and what's the other one? The other one. Other stock that's doing great. It was Hood's doing great. You can see Hood
Yeah, the
doing
core
great.
week. Was
What?
it core week?
Yes, Corey was shooting up hot. You
Yeah.
can do a little bit higher than money and hope for the best, but at the end of the day, it's much better doing the money because all you're really doing is you're relying on time decay. It's just simple,
Right.
easy. You're the house in the casino. Write it down. You are the house in the casino. In the casino. Which is what? To have an advantage. You have an advantage.
Yeah.
We're looking for advantages. And I'd rather you get 37% to go in the money, be a safe trade, than to try to get 75% and maybe lose some of your trades.
Yeah. So I'll tell you what the I did I did couple of spreads on two of the stocks.
Yes, what? Tell me.
So I did one for Amazon.
Amazon. Can you give me the numbers?
Yeah. So I
Give
did
me the price on Amazon first.
so the Amazon right now is trading at $200.35.
Continue.
And then I did a spread of 215 to 220.
215 to 220. 5 points. Now,
Yeah.
5 points is a small investment.
Right.
For you, for your size account, maybe do a 10-point spread, but let's do the 5 point for now, okay?
Hmm. And I
Continue.
went so the thing is I did this spread when it was the price of Amazon stock was $205, right? So that's when I had kind of written that spread.
So
Um,
you did it way out of the money.
so I did way out of the money. Yeah, I did like $10 out of the money, right?
So
Uh,
you actually do what I'm teaching.
no, because in the money we just discussing right now.
Okay.
Uh, so yeah, I did not do.
Now, is this still in play?
It's still in play, yeah, because I did it for like 3 months out. So September 19th is the expiration.
Well, it might be in the money by 3 months, but what I would do, can I tell you what I would do? I would close it as soon as you have a profit
Right.
and move it down. Okay. Now, Amazon. You're going to be a champion hero if Amazon goes to 221. But that means it has to go 21 points. Even in 3 months, it may not.
Right.
So what I would do as soon as you get some kind of profit on that spread, maybe Amazon goes up 5 points, 10 points one day, or 1 week. Amazon doesn't move like it used to. Back in the day, it used to move a lot like Tesla, but now it's kind of slow. So
Yeah.
I would. How much did that spread cost you, by the way? What was the cost for the 15 and the 20?
$180.
So here's something interesting. Considering you bought the 215 and you sold the 220, it cost you 180, and then 5 points is the maximum you can get for that 5 point spread. So the total return is gonna be 320. So look at this return, okay?
Mm-hmm.
Huge return, okay? If you can get the return, which you probably,
Right.
let's be real, you probably won't get that return unless Amazon goes to 120 within a couple months.
Yep.
But 320, 3.2 divided by the investment of 1.8, 178%
Okay.
return.
Right.
So it's almost double, actually almost triple your money. 178% return. So you can get out $320 at about $180 investment. If your investment goes to say $2 or 210 or
Mm-hmm.
220, I would just close it. I would.
Right.
If you see the market going up and Amazon going up steady, going up and
Yeah.
up and up and up, and maybe it'll go to 120, then you can leave it. But you're way out of the money. You're like gambling. This
Yeah.
is not the house. This is like that gambler that goes to the casino, has like the fancy shirt,
Yeah.
has the girls on his shoulder. It's ready to gamble, throwing a lot of money on the table, stacks of cash. That's you right there. Flashy. So ideally, you can do 3 months is fine, but you can also do 1 month. You can get your return faster.
Right.
I would do 190 by 195. Kind of look at that.
Yeah. Yeah. Let's
Look
look
at
at
that
that.
now. And I'm just gonna go. I'm just gonna go to the month option, not the 27th,
Sure.
because it's just easier and faster for me. So June 20th. Okay.
Mm-hmm.
The 190 is 1480. So on the 195 is 11. 360. So 360 cost, 5 point spread maximum, 140 income maximum. So let's do the math on that. 1.4 divided by your investment of 3.6, 38.8% return. It's not 170%, but it's a much higher chance of success, as Amazon will be 195 or higher. You got a 5 point buffer, you see.
Yep.
Amazon went down 2 points on Friday. See that?
Yeah. Yep.
And if you do the 190, 195, you still have another 5 point buffer. Whether you do it
Right.
3 months or 1 month, up to you. 3 months gives it more chances, it has more time to move. But because you know what, I like to do my spreads a little bit closer, like a month, because when I say it's more chance of stock to go up, there's also more chance to go down. And
Yeah.
if you have a long and a short, you have both a long and a short. So technically you're long, but you're also short. So it just makes more sense to me to do it closer, 2 months or 1 month, ideally.
Got it.
3 months, when I buy like a call option without the spread, or if I'm doing like a cover call, I get more value for the 3 months. I can do that. So in this case, the 190, 195 is a little bit more intelligent. So
Mm-hmm.
they get lower return but higher chance of success. And in this case, June 20th, that's what I would do. And the one you have, I would probably take the money as soon as I can.
Right.
And if Amazon, just starts going down, the market doesn't do great next month, next week, you're gonna probably lose your whole option if you don't sell it.
Right.
It better to sell at a loss to prevent a total destruction of the position, to
Right. And that's,
save money for the next trade.
yep. No, that's what I thought that I'm doing it for September, so I'll wait and see how it works out for next 1 month. If it goes up, because it did, the Amazon did went up to 215 2 weeks back, right?
So it has
So,
another upswing. You can just keep it or you can close it.
right.
But I think if you go on monthlies on the spreads in the money, I think you'll have a go monthly spreads in the money on great stocks. You have a nice result, I think.
Yeah. Yeah.
Questions?
No, this is good because I did another one for Affirm and similar spread. or $5.
Something Amazon, something Abaddon was doing, who I call the Rainmaker. He
Right.
was actually selling puts, which I didn't teach him to do that. He started doing that on his own, and that's also a long position where instead of doing a call, let me put this in your notes and get it in the video. He was actually doing a put spread, not selling the puts. He was buying the put. So let's say Amazon, right?
Mm-hmm.
Go out to the 20th of June. What he would do, stock is 299 cents. He'll sell, sorry, he'll buy the 215 put, buy it. He'll sell the 210 put. And what does that do? Looks like this. Cost 373. It's the same thing as a
Right.
call, but it's on the put side.
Right.
You're technically long because you just don't want you actually don't want the stock to go up past the 210. So technically, in that way, you're short, but you're long in the sense that you want the time decay to just,
Yeah.
because what will happen is on the expiration, in this case, as long as Amazon isn't above 210, between 200 and 210, it can assign the put automatically at 215, and then you buy it back at 210. You make $500. So the cost here is a very similar cost. It's showing me 373 now. So here, plus Amazon plus 215 put, sell minus 210 put, 373 cost, total profit of 5 points, 127. Similar to our trades, but now we want it to stay lower, okay?
Mm-hmm.
And the return is going to be 1.27 divided by 373, 34% return. We can go safer if we go in the money, more in the money. On the put side, in the money is lower than in the money is higher than the strike price. When you have a call, in the money call is lower than the strike price. When you have a call, you want to have the in the money to have value. But when you're buying a put, you want to be higher than the strike price to have value. And puts expire worthless when the stock price is below the option price. That's why when you have pounds here, you sell naked put or a cash covered put. Pounds is 120. You can sell like the 115 or 110 or 118 and get a nice return on the monthly. And you take the stock if it goes below 118 or 119. That's out of the money. But in the money
Right.
would be if the stock was 125 and your put is 130 or 140, 150. That's in the money. So same thing as the calls, but reversed. Makes sense?
Yeah. Yeah.
So it depends on what side you want to play. In a sense, if you've seen the chart go like this, back and forth, and didn't go up to those high points, you can do a put spread the same way you do a call, and you can assume or imagine that it's not going to go up to those points, so you're going to get the maximum return if the stock stays below that threshold. Make sense?
Yeah. Yeah.
Probably Tesla's better than Palantir. Palantir looks actually going up right now. Palantir is still going to kind of still going to new highs. Same for IONQ. Do you have IONQ?
Everything got called off. Everything got assigned last Friday.
Did you make money?
I did. Yeah.
Did you see it was up 12 points?
What is that?
Did you see the stock was up 12 points?
It was. It's like at 48, but my strike price was at $28. Uh, so I mean, yeah, there was no point doing a roll on that, so I just took the assignment.
when
to
I put little pictures, I know she's going up. I'm trying to tell you guys, hey, get in because it's going up, you know.
yeah, yeah,
But yeah, I think you'll be more safe, so that's good. Don't just jump because I say something, you know. Maybe do your research.
yeah.
But
I mean,
that's a good
I,
example. Go ahead.
no, no, sorry. I just don't like. I mean, I like buying the stock, but not at a very when it's at the peak. I would prefer to wait for it to come down a bit more, and then and then buy it and then do covered calls on it. It's
Patience.
yeah,
Patience will win the day. Here's IONQ. I was kind of happy with the chart, and like similar to Hood's creeping up. IONQ is creeping up again, and I'm
yeah,
sure what it looks like. Like you do the 1 year. Here's a 1 year chart.
yeah,
This is a 12-point move. This is 12-point move here, 12-point move
yep,
right there,
yeah,
and then
yeah,
here's the 20-day. 20-day shows a nice move to the upside. If I have all this here, I was just waiting for my, and I have spreads on this one. Just waiting for it to move. It moves up, and then probably I think it'll probably go higher. You know, so don't wait too long.
yeah.
Okay, questions on spreads.
No, I think
Yeah, you're a
that
champ now. If you had $1 million and you couldn't really afford to lose money because you're a mutual fund manager, you might do like pounds here, 90, 95, 90, 100, and get
that
like 10% return in a
yeah,
month and have like a 99% chance of it working out. You know, just do the math. Do like a Tesla. Like if Tesla is trading between 300 and 350, do a
hmm
do a just on your own time. Look at what a spread of 280 by 300 will get you for next month. And if it can get you 15% return or something like that, 10% return, high chance that that's going to be a successful trade. And all you're doing is just waiting for it to expire, time decay.
right,
You're using leverage of the options. You're going into money to give you a higher chance of success. And you're both long and short to control your drawdown. Only thing you're giving up is a lot of the upside, and upside that may never come.
right.
So that's why spreads are better.
Yeah. No, 38% profit in a month is it's still very high. It's much higher than doing any covered calls or selling puts and all. So
Yeah, but there's another risk. I told you the advantages, but there's another risk is that if the stock goes down considerably, it will
yeah,
still wipe out your whole position.
right. Yep, yep. Yeah, there's
So,
considerable risk as compared to the
so
call.
I rather. It's nice to have some shares because the shares are going to be there.
Yep.
Sometimes I'm tempted when I do a spread, and let's say it's 5 points. When the stock shoots up like IONQ, it won't give you the full 5 points until the expiration. But sometimes if I get in for 250, which is a double 50% return, I do a 5 point for 250, 5 point spread, and the stock will shoot up, and I'll get like $4 out, which is like most of the return, but not all of it, which means I made 150 for 250 plus $4, 150, 253. So I made 150 out of a 250 investment, and there's only one more point left. I have to wait a whole month to get 1 point. I'll just close it early, and then open up another spread next month for 5 points. That way, I'm getting the advantage of the upswing, taking advantage, closing it, and then I can reopen another one next.
Got
If I
it.
have, if IONQ is going up, or pound is going up, or my stock CoreWeave Hood. On Hood, by the way, I have 60. I have 55 by 60 on Hood, and now I went to 64. So now I'm
Right.
nice. I'm in a nice position right now. What I'll do is, if it has considerable profit, I'll close it early. And let's say it goes to 70, which it probably will go to. Then I'll open up a 60 by 65. And then when it goes to 75, close that, open up a 65 to 70. I'll stay in the money and write it up like this, making money every time, you know.
So you go 1 month out, right? And then
Yeah.
when did you put that spread of hood? When
I keep trading it, but I usually go a month in advance. So I started, you know, let's say I started in April and I did May, and I may have been on 50 to 55. And as I started going up, I'll get 55, 60, I'll close it and open up another one. So just generally, you start with a month out, and if you get considerable profit, you can close it and then write it up with the stock. Because why? Because if you have a stock that's going up like Hood, and you have a 5 point spread, which is a great return still, and you're in at 50 by 55, which it was at 55 recently, correct?
Yes.
But now you know it's 64. It all went all the way up. So now you close your 5 point spread for 50 to 55 because it's way in the money. It has a lot of return. But you're not going to get the full 5 points until the expiration. You want to
Right.
be going to save the time. Close it 50 by 55. Open up a 55 by 60
Right.
and then see how that one works. And then if it goes to 70, now you close that one, do it again. And the value is that if Hood eventually would go to 80 or 90 and then drop back down to 60, you have all these profitable trades, and you only lose on the last one. That's why. Because if you have a one trade, whether you're doing 3 months or 1 month out, like you were doing, and let's say you're in Amazon, Amazon can go up like this nicely every day, every week, and then finally, before the expiration, it can come all the way back down.
Yeah.
If you lost all your profit you gained.
That's true. Yeah.
That's why I like to move with the stock, move the trade with the stock. And if you have a nice return, close it and stay with the stock. Open up again, higher, close that one. Every time you're going to get little steps, a little step pyramid,
Right.
and that way you're taking the benefit of the share growth, and you're not going to have a big loss if it comes down at the end. You're going to have little profits along the way. Right
Got
now,
it.
take small profits along the way. Now, it's not wrong to just leave your position for 3 months and get the full amount at the end. That's not wrong. But I feel like the holding's at risk if it can just come right back down. You know what I mean?
Yeah. Yeah.
So I like to take small profits along the way. Write it down. Take small profits along the way. Close it early. Open another one higher. Close it early. Open up another one higher. You might have, whether you're in Hood or Amazon or Palantir, you might have 2 or 3 profitable trades just from one trade, and you're just doing more and more profitable trades. It may just add up over time. Stock's going up, you stay with it. You said that your IONQ got assigned, which is great, but what you could have done, you could have closed it. You could have closed the cover call. Now you have the shares. Bought back your cover call back, and then did a higher cover call. This is trading along with the share price going up. Let's say IONQ is 20. Let's say IONQ is 30. You sell the 35. So now IONQ goes to 40, 45. You buy back your call.
Right.
Now you sell the 50. Then it goes to 55. Buy back your call. Then it goes to 60. The value is that you still have the shares. So the shares are still going to give you a overall benefit. You're not actually losing money. You're losing money technically on buying back your call higher, which is
Yeah.
the short side. But if you count the shares you have, that has more of a value. You're going to be long on the whole, and you're still making money as it goes up. So you could technically buy your call back as it keeps going up, and that way you're making not the full amount, but some money, and you're able to keep going with the share price instead of just closing it, like getting signed, and having to wait till it comes back down. Different strategies. It's not wrong the way you do it. That's the best way because it's easier. But if you're a little bit more savvy, and you can see the stocks going up, you can just buy back your covered call, knowing that you have the shares. Shares will give you more value, more profit, and then just raise your covered call as it goes up.
Right. Because then I could have had that $20 profit back if it got assigned, if I did a higher covered call, and then if it got assigned later on, or if
Yes,
the shares keep going up. So I can always recover that money easily. Uh,
yes.
got
Good,
it.
good, good thought. Good thought, man.
Yeah. Yeah.
Questions?
No, that's I should have thought about that. No, that's a right. Yeah, now I
Now
got it.
you're in cash. Now you're in cash. You're sitting there waiting, right?
Yeah, yeah,
If the market does great, and IONQ and Palantir and Hood are doing great, you might as well just get back in. Give yourself a few days.
right,
If
right.
you don't see
Yeah,
that dip, I want you to be patient. Maybe you're more patient than me, which is great. But if you're not making money, if you're just waiting and nothing happens, you just gotta get in. You know.
yep, yep.
All right. More questions on that?
No.
Ellen, I think we have enough time to do affirmations. Want to do that and
Right.
then close?
Sure.
Okay. Um, Affirmations is part of the training. Um, oh, we didn't do put hedge. Let's do put hedge. Look. This is real quick. Take the SPY, SPY, and this is a quick put hedge. Okay. The SPY is 579. Okay. 579. Go 30% in the money. Okay. Which is is signifying a 30% return, like a correction. Okay. Go it's May. So go January, which is 7 months. Go like 6 to 9 months out. In this case, January 2026, 236 days. And then go 30% of the money. So if it's 580 times 30, it's like let's do the math. 580 times 0.7, 406. Let's just do the 400. By the 400 put, okay, for January, all right, on the spot. For the put cost, $4 by 411. So go January 26, 400 put is 411 by 416. Let's just say you spend 415. So you spend $415 for one contract. Okay, you're gonna protect 5% of your account because your account is basically long, right? Dividends, cover calls, share growth, spreads, right? Basically, you're long.
Right.
So if you have 50K,
Mm-hmm.
5% would be $2,500. Correct.
Right.
So you go $2,500 to 5,000, and then divide by 415. 6 contracts. So with 6 contracts of the put, you would protect your account from a correction. That's what it really is. So you do 6 contracts. You're gonna spend $2,500 out of a 50 grand account. If your account's 10 grand, you'd only have to have $500, maybe one contract or two. Your account's 100 grand, you want to spend around 5 grand. Now, here's the magic of the spread. With 5%, you're not just coming out of your pocket with that money and spending it. We know that we can make 5% return on Palantir, on Tesla, for a cover call for a spread, right?
Right.
Easily cover call on IONQ, on Rigetti. You saw Rigetti?
Mm-hmm. Yep.
So you're taking your profits, reinvesting them to buy yourself a put hedge for what? In case of a market correction. Why? Because it's going to protect your downside. You can't afford to lose a lot of money, and you're playing both sides. You're hedging.
Mm-hmm.
When you haven't managed a lot of money, you can't afford to go to a correction and take a 30% loss. So when you have a 5% put hedge, in this case leveraged, instead of have a 30% loss, you might only have like a 18% loss. And that's a huge difference. Because when we lose, because a lot of diminishing returns, when we lose in the market, it's going to hurt us more than it helps us when we gain, correct?
Right.
Because of the fact that if you lose 50%, for example, you get
Yeah.
100% to return that. Whereas you gain 100%, nobody really cares. All right. So the benefit is this, okay? Take a look at today at the puts at the money, okay? The puts at the money are 579.
So for 27th May, is it? For SPY?
No, just no for today. Yeah. How much is it?
I mean, the 27th is 579 is 306 to 310, right?
I have 11 by 1185.
Okay, I'm looking at
Wait,
the
wait,
wrong
wait, wait,
one.
wait. No, 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 yeah, no, no. Hang on, hang on. I do it right. I do it right. You're doing today, right?
Today, I mean, I'm in Thinkorswim. It's showing us 27th for the option date. Today is 25th, so it's showing me for Tuesday.
Okay, so now if we were to go down 30%, what we're looking to do is what is the option going to be if we go down 30%? Okay,
Mm-hmm.
so what we would do, we would add 30% to our puts. We go in the money by 30%, which is to 400 to 5 is 180. So we would do 580 plus 180 is 660. Does that make sense?
Okay,
So if we went in the money, if we went 30% correction, our options will be as much as $82.
right.
That would be if we had a crash like tomorrow. Okay, the $4 could be like $82. Just to look at where that put can go. You know, actually, it won't go that much because let me talk more about this next session.
Okay,
But you don't have the luxury to get clobbered by a correction. You want to be both long and short. So what the mutual fund managers do, they always have a put hedge. They always have some puts. And when you have some puts, let's say you have the 400 strike for January, when the market starts coming down, you're already making money. Those puts are going up. And you can always add a few puts if you want. You think the market's really going to go down. But sometimes it just goes back up. You have the
mm,
choice. You can close at a profit and take some profit, or just leave it and see what happens, see if it goes down more. Because it's like fire insurance. You don't want your house to burn down, but if your house burns down, you can have something to start over. Same thing with the puts. If the market goes up and everything does great, that put hedge is going to expire worthless. The
right.
value is only 5% return, and the value is only 5% cost, and it can go up double, triple, quadruple. So it can protect you if the market goes down in a big way. So you're protected. You protect your drawdown. Write down. Put hedge protects your drawdown. That's what it is. And even though it's only 5%, it can be meaningful. You know, if it's a correction, if it happens fast, you can close it at a profit, or you can just leave it and see what happens. And once we get, let's say it's May, so once we get to like September, October, just close your January's and then make it for the next year out or for the next 9 months. You don't want to expire these options because you want them to be, valuable. So you close it and do another one. And ideally, you get the money what? From cover calls. Take the
Right.
money from the cover call, 5%. You take 1 month out of the year, take 5% for 1 month. You know how we do 10 cover calls? Take one of those cover calls, 5%. Invest that in a put hedge. So you're short when the market corrects, and you have a choice to sell at a profit or leave it and see how deep it goes. Make sense?
Yep, yep.
So the big money managers always have that because they don't have the luxury to just get clobbered by a correction. If the market goes down 30%, which happens sometimes, the mutual fund managers may only lose 10% or 20%. Huge advantage. It's not going to protect all your positions, but it'll protect some of your positions,
Right.
some of your account. Questions on that?
No, no.
Should we close it at a win, or should we do affirmations? We can do affirmations next week.
Okay, sounds good.
Affirmations are just saying basically like you write a note, like a goal. Wise man says, if you don't have a goal, you won't get there.
Right.
So have a goal. I'm gonna make $10,000 in my trading account this month, or I'm going to pay this many bills this month.
Right.
Or I'm going to do 3 successful trades back to back. Goals, affirmations. My account's doing great. My family is safe. My kids are flourishing. You're giving yourself positive energy.
Mm-hmm.
It's going to help your trading. It's going to give you a better outlook on life. And what they say, have you heard Napoleon Hill? Thoughts are things. So this energy you have in your mind, which is your creator, is going to manifest in your life. So you're giving yourself positives.
Oh yeah.
If you look at the world, too many negatives, you know, a lot of negatives, a lot of conditioning. These are positives, and you're going to see that manifest that in your life. And then when you see it on paper, oh, look, your account went up just like you planned. You had a goal, you reached the goal. Well, other
Yeah.
guys, just, no goal, just going through life like this, and then they don't have the result, right?
Yeah.
We'll get
Right.
more to it next week. Sound good?
Sounds good.
Questions?
I think this is good.
Good, good. Make a few affirmations for yourself, and we'll look at them next week. And next week you graduate, correct?
Yes.
You're gonna show up with your graduation cap.
I never wore one.
Go over the 12 stock selections. Go over cover calls, dividends, maybe some spreads, and just basically tell people how time decay works and how you can retire in the stock market. You're not gambling. You're doing proven strategies that work.
Right. So is
And
the presentation next week or the following week?
next week is your 12th, right?
Yes.
It's your 12th. Yeah, that's it. Next week.
It's the 12th. Okay.
We can continue with some sessions. I'd like to do that with you. I'll just charge you $50 a session. But the next week is your final for the course. And
Got
by the
it.
way, I appreciate you're doing great. I can tell you took in most of them, all these lessons, and really turned it into your knowledge for use and your trading. I can tell you've taken well to the course. I appreciate that. Congratulations.
No, thank you. Thank you. No, I've learned a lot. Done a lot of successful trades, some misses as well, but I think I've recovered quite well from it. And
Yes.
I've called you a couple of times for guidance and everything, so that has helped a lot.
Just think
Uh,
we're going to be in 10 years, man.
I know.
Exponential growth.
I wish I had started sooner, but I guess never too late.
They say when the student is ready, the teacher will appear. So you start at the perfect time when you're ready.
Yep.
Thank you, Rohan. I'll send this to you as soon as I get it.
All right. Sounds good.
All right, take care.
All right. Take care.